we are going to do something about tax planning. And a lot of folks, though, with the election year, right, November 5th, and we're going to, casting our vote, decide on the future of our next 4 years. And with that said, a lot of folks are waiting for the result to really plan anything. And I will say to you that don't do that. In the tax world, this election really don't have a lot to do with 2024 tax planning. 2024 rules and regulation is already there. What you can do with your taxes is already set in stone. It is about you taking actions, move forward a bit early. So we have 10 very best tax planning opportunities for 2024 to present to you. I'm going to do 5 today, and not next Saturday, the Saturday following, I'm going to do the other 5, but I will give you the topic today so you can see where I'm going. Right now, you're looking at our website, am I right? And you can see on our website, you can see that we have appointment button. That's where you can meet me, and you can book my time and all the other partners' time. So the tax planning is something I want to push out early because a lot of those content do need time. You can't do it on December 31st. It won't work. So you need to do it a little early. 10 best tax planning opportunities for 2024, part 1. All right, let's get going. About our firm, right? About our firm. We have 27 years practice history. And what I want to impress you is that we speak 10 different languages here. Among our professional staff, we have about 40 of professional staff. And we have 4 branches currently. Actually, we have 5 branches now. Des Moines, Iowa City, Minnesota, Bloomington, and Capitola, California, and Houston, Texas. So those are our branches as of now. And I myself has served in a IRS panel, the federal organized advisory committee to provide advice to IRS for 3 years. And I have also written 2 books. One is Appointment with Ying at 8 a.m. The other one is Appointment with Ying at 10 a.m. Each one these hours representing a status, the stage of the business, starting a business, growing the business. My 2 p.m. is here, and I am working on that book. It is Expanding Your Business. In fact, the book kind of reflects on the journey of community CPA. We started back in 1998. We grew for the last 20-some years. And I want to say that for the last 5 years, we really are in the mood of expanding. Not to say every effort was successful, but every effort we did, it is a point in that book. I want to bring the failures we experience, failures of our other clients who experienced, and the success stories of how other people did, and also success stories about community CPA in one book for you. So you don't look at one person's history, maybe glorious or what, but you look at a collective entrepreneurs, how they actually expanded their business from nothing to multi-million, billion-dollar business, right? So look forward to my 3rd book. These 2 are on Amazon already. You can order and purchase from Amazon. If you are near one of our branch location, we also have the book there. You can get it and from our front desk and for those books. No responsibility disclaimers, and you know what I'm trying to say here. And let's move on to our first 5 for 2024. Tax planning opportunities, right? Well, that's what we're talking about. First 5, business structure planning, income planning, asset planning, passive losses planning, and bunch deductions planning. So want to make it kind of short and to the point. So in your mind, you're thinking of what we are doing here, right? Structure. And we talk about income planning, asset planning, and the losses planning. What if we got a lot of losses already? And the bunch deduction planning. And people say, oh, what is that? You will know. That's why we bring it up. This is first 5. The second 5 is 2024 COVID planning. You'll see, yeah, there is COVID for 2024. Yes, there is. So come to our second 5, not next Saturday, the following Saturday. Children's tax planning, that's related to you as a parent. Mother-in-law planning, you wonder what that is, right? Yeah, it is the seniors and sort of related to you, and tax planning. And those are key points you want to exercise in 2024. Business closure planning, very important. Retirement saving planning, the last but not the least. And this Tuesday coming, we will be talking about maximize retirement contribution. And I want folks to come to that 30 minutes because I will draw out exactly how you're going to put in the most retirement funds in 2024. You want to ask what is the most? The most retirement funds you can put away is $69,000 in 2024. So we will cover that on the second 5 opportunities. All right, let's look at the structure planning. Reassess entity structure. I say reassess entity structure because you already have one. You are already operating your business. You already know what structure you have. One of the structure we all have, whether you have a business or not, it is your individual 1040. That is a structure. That is an entity. That is one of the entity that you need to plan together with your other ones. Evaluate your current structure. Determine if your current entity type, is that a sole proprietorship, partnership, LLC, S Corp, what? What do you have? Is it still most beneficial for your tax situation? As income increases, it will change the landscape where you are on and changing you from sole proprietorship to a LLC or to S Corp may reduce your taxes, give you additional tax benefit, right? So here we talk a lot about self-employment tax, and you want to pay self-employment tax because they are your Social Security Medicare benefit, right? And hopefully nobody gonna come out of somewhere and talking about diminishing the Social Security benefit. No, Social Security benefit is a landmark of United States of America where they provide retirees a peace of mind, right? They don't have to worry about what they spend. They can get that money without worry about anybody went bankruptcy. You can put your money with a private banks or financial institution, just like I run. It goes belly up, and people who saved their retirement in there is gone. But the government should act differently. The government should act with responsibility. If you promised people from they were young, saying that you work, you pay, then we give you retirement when you are older, that need to be there. So self-employment taxes is a stream of income for Social Security Administration to have that be in the trust fund. So when each one of you go through retirement and you all draw from there. So I'm not saying that we don't want to pay self-employment tax, but we only want to pay so much that it is the correct amount for us when you retire, you can draw, right? So that is definitely a consideration to see how much self-employment tax you're paying. Consider as corporation status. This is something a lot of people know. If we have to put tax knowledge into school system, right? So I would say, to consider yourself moving from sole proprietorship or LLC to S Corp to S Corp status for tax benefit, that is the middle school knowledge. And any semi-successful businesses would have already been exposed to that idea. You kind of know, oh yeah, I go to S Corp. You may not articulate why exactly you go, but people tell you that, oh, just elect yourself to be S Corp, then you will save a lot of taxes. So you heard of that. That is a one way to save self-employment tax for sure. But creating new structure to shift income, that is a high school or college level tax knowledge. You don't have to gobble down things when you are not even graduated from middle school, high school yet, and but you have professionals that you can rely on. This kind of work takes time. You cannot be saying that, well, today is December 31st, 2024. Ying, I just heard that if I set up this new structure and we will be saving a lot of taxes, that would be too late, isn't it? Because it's already cutting into the last day of the year. So a lot of these structure changes, ladies and gentlemen, really require you to do it early. And I am so proud to tell you there are so many clients we have are actually taking actions now already. They're not waiting for the last quarter. They're not waiting for December. They're certainly not going to taste the regret pills after 2024 is done with new tax changes. Who knows which way they go? Then you will be regretting. You didn't do that today, right? And you want to, every changes you make, you want to mathematically calculate the changes in your tax amount. Each business structure has a different tax implications, am I right? See, for example, we mentioned about S Corp, and to elect that to be S Corp, you save about 15% of self-employment taxes that you otherwise would pay. And if you are moving yourself into a C corporation, there is a double taxation of corporation income that you want to calculate, because after you pay the corporation income, if you want to take the dividends out, that is a dividend tax plus the 21% of corporation tax, right? 21% of corporation tax is not expiring. With the Job Act, there's many things are expiring, but 21% is not. That was set in the law. Of course, new law can replace old one. There could be effort doing that, but the 21% is pretty set in stone for corporation. So just keep that in mind when you do these reassessment of entity structure. You want to know how C corporation works and how trust works, how family LLC works, right? These work, like I said, they take time, and you want to reassess what you have, come up with a tax saving based on structure changes. So the next slide I have is actually wanting to give you an example of a family limited partnership. The reason I give you this example because this one addresses how I created a new structure to shift income. That is exactly doing so and more. So examples of that, a family limited partnership, we can set it up right now for 2024, is a business structure where family members pool their resources to manage business together. Okay, the partners inside of this structure has a different functions. The general managers are the one in control. So maybe it's the father is the general manager, or the wife and the kids, are the limited partners. So those are the ones you can classify them. You can give them a certain responsibility to the partnership that would trigger the tax treatment to be different. So these partners, the general partners are the partner manage the business, have unlimited liability for partnership's obligation. And then limited partner, opposite of that, these partners invest in the business but do not participate in management, so their liability is limited to what they put in. All right, so with that, you say, okay, I can do that. What's the benefit? What's the catch, right? The benefit, asset protection is actually one of the top benefits. This kind of LLC will protect your asset from creditors. The other benefit is what I am focusing on, that is immediate tax saving. This kind of LLC offers potential saving, especially in estate planning, by allowing for a gradual transfer of asset to the son, the daughter, the heirs, potentially reducing estate and gift tax. So you may say, well, that sounds complicated. What do you mean by allowing gradual transfer? Transfer has rules and regulations. A gradual transfer means year by year. And by transferring that, you understand our gift taxes, right? $17,000 mom to a son, and another $17,000 is father to the son. So the son has $34,000 total. So yes, if you give cash, it's $34,000. But if you give membership unit of a entity, that is an evaluation. Because it is controlled entity, there is a discount you can take. So the valuation can be lower value, and so the unit can be transferred faster, right? So with that said, it gives you an idea that this type of entity can shift the asset from mom and dad to the children. And so there no longer belongs to mom and dad estate. In case they passed away, they got too big of an estate, there'll be an estate tax to them. In this case, they are reducing, you're saving, right? We want to mention this one into 2024 because we just have a lot of baby boomer parents, our clients in our firm as well. And those folks, every year is an important year for them to think about family limited partnership. I hope that folks who are listening to this webinar also know folks that who has assets out there, have a lot of value to it, easily go over $12 million in the market value if they die today. And those are the people need to plan taxes in 2024 to get this structure in place so you can gradually transfer money transfer the asset, transfer the estate to your heirs. It is important. It is important to know that this is part of your succession planning as well. And you have to customize that to your needs. There's no cookie cutters. There wouldn't be a possibility like for us to not know you at all, be able to say that, oh yeah, family limited partnership is one of the things you need to do. No, this has to come from knowing you so well. And you know that, one of the clients told me that, Ying, who knows me the most? And I said, of course it's your kids, right? And your spouse and your kids, the families knows you most. He goes, no, not my kids, maybe my spouse, but the second person in line who knows me the most is you, because you literally knows every penny where things are with our family. That is so true. So you want to select a tax person that you can trust and rely. And you do have to know that there's everyone leaves their career, right? One day I will retire, and one day you will retire. But in this planning phase, you want to think of the succession, even for your CPAs that you work with. You want to know whether they have a succession plan. And at Community CPA, we absolutely have succession plan. It is kind of a blessing that our partners right now in the firm and our professional staff here at our firm, we have such a young average age is not heard of. So it is a blessing because we were able to get hold of young people into the business. What that means is you can rely on community CPA for much longer term because we will go on and we have the succession plan coming in as a firm, as a business, and you need to do the same. You need to do the same so you can plan your future. But to do that planning, it is really starting from 2024. That's why I brought this example up because it is a entity type that need to be set in order it to slowly going forward to save your taxes day after day, year after year, generation after generation. All right, so our next one, this is our structure. So now let's talk about our income planning. Structure, we are done with structure. Now let's talk about income. Income planning, I listed couple of important ones to just impress you. Income planning is very detail oriented, which means that even you are our client, we cannot do income planning for you without knowing your financial statement inside out. It is what I call accountant planning. It is a planning that you need to do with your accountant, not a big picture, not grandiose mission talk. This is really a down to the bottom line, and we look at numbers, we go, that do not need to be an income for 2024. Deferred income, a really simple strategy that has always been out there, which is to defer your income until the following year, right? So if in December you're getting checks from your client and one of the check is $150,000 and the client wrote that check to you and you're supposedly to deposit, but if you do, this income will jack up your taxes. You have no chance to spend that yet. You already need to report, right? So deferred income strategy just means that you take that check, you put in your pocket, wait until the New Year bell rings, January the 1st come, and you deposit on that at January date, not December. Deferred income. Review account receivable. Why? Account receivable is what? Account receivable is the income we expected to receive from our client. And we could have a bunch of receivable that we know we're going to get from our client, but we also know that a lot of them are so old. Client, we try to call and they don't pick up the call, and they just seem to be disconnected from us. As a business owner, you want to review these receivables and know that some of these receivables may be not really your income anymore, right? You want to go on to the next point I wrote there. Before the end of the year, business should assess outstanding debts to identify any bad debt can be written off. Maybe you just lost connect with that person, or maybe the money you didn't get it is from your brother-in-law and you were too shy to collect and they just pretend they never owe you anything. What are you going to do? I would write it off, right? It's not really, I don't know, someone would disagree with me. Goes, no, Ying, I would just go after him. I know where he lives and we always get together on our mom's birthday. I know him and I just gonna go to collect. Yeah, you can do that. But if you ask me, I'll just write it off because he's already there owing you for over 120 days. There's no intention of paying you. If there is really an intention of paying you, he probably already did installment payment to you to cover your not received income. So evaluate that receivable making management decision on what you need to write off. So you may say that, oh Ying, what is the magic number I can write off? So I don't know, if I write off too much, would IRS go after me? If I write off too little, it's not worth of my effort, and I want you to tell me what is the magic. The magic is reasonable and necessary. There is no formula you can get from IRS website to tell you how much of bad debt you can write off. But there is a generally common sense you would use in your business, and you may say that I'm going to write off this $1.2 million, and because 5 years ago I had a similar situation, it is indeed was not collectible, it was written off. My average of written off is like 20%, then you use 20%. So those are the things you can reasonable, articulate. You talk to your accountant. Everything you do should be according to GAAP, right? So just make sure that you talk to your accountant and get that reasonable write-off calculated for 2024. Prepay expenses is another one. It's also called the 12 months rule. So the 12 months rule means that to allow small business to deduct prepaid expenses under certain conditions. So conditions is more like it has to bring economic impact. You must be a small business with less than $10 million turnover cash. I didn't really go study what is turnover $10 million means to define as a small business, but that's what they said, the small business definition. So in any case, that's your 12 months rule, and you can prepay your expense. All right, so that's your income planning. So you defer, you delay it, and you write off more because you have a bad debt, and you don't believe you're gonna get it anymore, and you pay expenses early, so that way your income go down, right? All right, now, third one, asset planning. And I know there's a lot of talk about asset planning. You are super familiar with, people talk about cost segregation, depreciation analysis. They talk about bonus depreciation, and they talk about, obsolete inventory, asset write-off, all of that. But I want to bring this 481A to you as a highlight point to embed that into your mind. So when you made a mistake, when a taxpayer, when a business changed their method of accounting for depreciation, so maybe before was straight line, so now they want to do double line, or now they want to take bonus depreciation, or now they want to have 179 section deduction. They are allowed to make a section 481A adjustment. This adjustment is the difference between what was done wrong and what should be done, that difference under the new method. So you put that difference under the new method, and on your depreciation schedule, you indicate that is section 481A adjustment, and you don't need to go to amend the past return. Congratulations, yes, you do not need to amend the prior year return to correct these depreciation errors. I call that errors. They're really just accounting method change. The adjustment is made in 2024, so simplify the process to correct the past errors. See, 2024, plan. If you could figure out section 481 adjustment in 2024, you bring more deduction to yourself, right? Of course, the other one is assess obsolete equipment and inventory, because those obsolete equipment may still have a book value, and you may be still depreciating $5 a year, that kind of thing. Write them off. You don't need them anymore. You don't use them anymore. So when you write them off, you have a loss, and that loss become your deduction again. Same thing with inventory. And especially in some retail business, they could be buying a whole bunch of inventory but just not selling. And if you can't sell it right away, they may even expire. So what you need to do is you need to write off the whole set of inventory you bought, right? Those are expenses, ladies and gentlemen. They are cost of goods sold. So you want to go ahead, really account your inventory properly, count your equipment properly, and write off all the obsolete equipment, write off all the inventory that you can't sell anymore. So that is a year-end work, and you should do that work for your accountant, so your accountant can book the inventory and equipment accurately on the balance sheet. By the time the accountant goes to the tax accountant will realize your saving for you on the tax form. The last point for asset planning I want to mention to you for 2024 consideration is the bonus depreciation we all know is fading away. 2024, 60%. That means when you got a piece of equipment and 60% of that you can deduct, there's a 40% left. So our recommendation, planning tips for you, acquire and place asset in service in 2024, allow the business to take 60% deduction, but combine Section 179 if the deduction is not enough for you to offset your income. If you still have profit after this, and consider using Section 179. Make sense? So we got asset planning, and we touched on some really important concept. 481A adjustment change. Then you also have the inventory, equipment obsolete and write-off. And now we talked about bonus depreciation, how possible, how that could be together with Section 179 to reduce your income to the maximum. All right. So we touched on the income. We touched on the structure first. Then we talked about income planning. Now we talked about asset planning. The next one I have for you is the passive losses planning. Utilize your carryover losses. Do you have passive loss on your tax return that you just can look at it but you can't use it? There's a lot of clients, when they come to Community CPA for the first time, we often catch that issue. That is a money deposit on an invisible bank you don't collect. That is treasure hunting for us. So if you have a passive losses, in 2024, plan to offset, to use the passive losses. So how is the passive losses come about? So passive losses coming from exceeding the passive income. So if you have passive income, passive loss, the losses had bigger number in any given year. The portion that could not be offset from the passive income is carried forward to your next year, your future year tax returns. These carryover losses can be used to offset the future passive income, reducing taxes for the future. But if you never plan the future, you don't do anything with that, you may just carry it, never use it. So consider selling an investment property, which like a rental property you have in 2024, which you expected a high passive income you receive high passive income, you receive a bunch of money, to use that offset your losses in your book. And a maximize passive income classification, that is one way. One way you sell an investment property, you have the passive income, but the other way, you create the passive income through classification. So structure your real estate holding to produce passive income. Just hear it, structure. tax structure come back here again. Yes, so you structure your company to produce passive income. Why? Because it can offset the losses you have in your book. So there I have an example, say redeploy asset generating interest and dividend and into activity producing passive income. Just turn the activity from active income to passive, reducing material participation in a business can also reclassify the income into passive. What does that mean? That is like the family LLC we talked about and the classification of general partner and the limited partner. So those are things your tax professional, your tax strategist would know exactly how to move that around and reproduce your passive income, and so you can use your losses that are on the book. All right, so this is about passive losses planning. My last one, but not the least, I know it is a good one, is about bunch deduction planning. You want to put your deduction together. That kind of planning. Yes, it takes planning because you can't just do it when April 15, 2025 come around, you are rushing into deduction, right? Bunch deduction is a tax strategy that involves consolidating deductible expenses into single tax year, into single 2014 year to maximize your itemized deduction sheet. It's called Schedule A. Schedule A is that standard number, right? So a lot of folks don't have a way to go over that amount. They take standard deduction. But you can maximize your itemized deduction by having this strategy put in place. The approach is particularly useful in light of increased standard deduction, which has made it more challenging for some taxpayers to itemize their deduction annually. Charitable contribution, medical expenses, and also state and local taxes are the three areas that we can see this bunching methodology would work. So let me show you. Charitable contribution. Charitable contribution, if you stipend, if you give to your church every year, and you know what you're going to give next year. So if you can move your next year's into 2024, then you deduct all of it, right? So that's a bunch. You can bundle the 2024 from what you're going to pay in 2025. All right. What about this, what we called donor advised funds? This is a charitable donation that you actually would set up a fund for the nonprofit, but the whole bunch of the contribution you had first out, that would be deducted in the first year, even though the money goes to the nonprofit is little by little every year for several years ahead of them. So this is where the charitable contribution can come in the bundle. If you are saying that, okay, that sounds like a good idea, but I'm a little fussy about exactly what I should do. So the point number one is pretty straightforward that you can do. You take 25 into 2024, but the donor advised funds, those are like trust funds, right? You need to set it up so that way it can go as you like to do. That's why they call that donor advised funds, because you are the donor, you are the one making decisions how the future payment come out. The large contribution would come in as well. And in here, in this one, sometimes people donate properties has the negative carried forward losses on it. Those are also your bases you can deduct. I know I added into a little complexity here when I talk, but you just understand that you can bunch up that charitable contribution for yourself. Medical expenses. Medical expense can only be deducted if they exceed a certain percentage of your AGI, right? Remember that's 7.5%, right? You have to, let's say your AGI is 100,000, then it has to go over 7 point some percent, let's say 7%. That means it has to go over 7,000 before the first dollar can be deducted. But if you anticipate you're going to have significant medical expenses, which normally if we're not getting into unexpected accident and you have a procedure you're going to do, you would know that. So if you knew that is coming up, you can time these expenses to fall within the same tax year. Okay, so that would allow you to over exceed that threshold and deduct more. So medical expenses is something that you want to bundle whenever you have a chance. The state and local tax, they call the SALT tax, and this is the one that when Trump was the president, and he took away the deduction that many taxpayers can have for the state local income tax. And he lives in Florida, so he doesn't really care about what other states are doing. Like people who live in Midwest, we pay state taxes. In the past, we're allowed to put the money we paid on the state taxes on our Schedule A to deduct as an itemized deduction. So most of the Midwest taxpayers, the people who are our clients, we see them itemized deduct because they're paying like 40,000, 60,000. Some taxpayers, I knew the name in my head, paying $120,000 to the local tax, to the local state, to the state. So they cannot deduct that 120,000 anymore after Job Act. So this particular rule, the state local tax only limited to 10,000, is really for the state that doesn't have income taxes like Florida. People lives in Florida, they don't pay state income tax. They only pay sales tax, so they can do property tax and sales tax. Maybe they can stay within the 10,000 because that's a limitation. So this one is expiring right now and at the end of this year. So I hope it's not going to be restated because it's very disadvantageous to our Midwest taxpayers. Same to California, is very disadvantaged to California. So our branch area, other than Houston, Texas, all of our other branches, they are actually suffering from this particular tax, the tax rules that President Trump put in, via the Job Act. But, there's states who doesn't charge income tax and they actually don't care. They're okay with the 10,000. So with that said, this is another one that you can bundle. And remember the property tax, they always send you one tax in September, one in March. Just bring the March over to this year, then you can get that bundled up and so you can deduct, right? So bunch deduction planning, this is where the areas that I am looking at to help the taxpayer to be aware of what can we do for Schedule A to maximize our itemized deduction for every taxpayers we have on our book. And with that said, this is the 5 I was going to cover, right? So we traveled from the structure changes, income, asset, and then we had income asset. What was the other one? Passive losses. So we had income asset, passive losses, and now we talk about the bunch deduction. So those are the 5 we have for this time. And with this, I will wrap up today. And this is our YouTube channel, you know that. And to subscribe, if you like our webinars, you like my talk, please give me a thumb up. I drink those because they're better than alcohol and make me excited. And the website, communitycpa.com, and I already showed you that. Catherine's email's right here. Catherine at communitycpa.com. She really is the librarian, is the marketer. She is everything in our firm, and she will tell me what I need to talk about at a certain given time. So it's really proven to be so effective because we always seem to be talking about what's in your mind for the last 4 years. So before I wrap up everything I want to show you, the second set of 5 that we talked about, then the second 5 I will talk about in the following Saturday is 2024 COVID planning, children tax planning, mother-in-law planning, and business closure and retirement saving. I will see you again on Tuesday, where I will dive in a calculation on retirement. It's sort of like the footstep, the first layer of footstep to go into this retirement saving planning talk in the following Saturday. I'll talk to you again. Thank you for listening to me and be with me today. Bye-bye.